The target company has 1,247 employees. The acquisition price is $340 million. The plan, documented in a slide deck you built over 92 hours across 11 days, is to cut operating costs by 23% over 18 months and sell at a 3.2 times multiple in year 4. The 23% cuts have not been announced yet. The employees know an acquisition is happening. They do not know what the plan contains. The press release goes out Tuesday. You have read the plan 14 times. The plan does not use the word layoffs. It uses the phrase workforce optimization. You are 24 years old. Your title is associate. Your base salary is $147,000. Your year-end bonus last year was $109,000. The combined $256,000 is the price the fund pays for someone willing to build the slide deck over 92 hours and read it 14 times and not say out loud what workforce optimization means in practice. You know what it means. You have calculated it. 23% of the operating cost base of a company where labor represents 61% of costs means, at the lower end of the range, a reduction of approximately 286 employees. Approximately. The model uses headcount ranges, not names. The slide deck has 47 slides. You built slides 1 through 39. A vice president built slides 40 through 47. The financial model, the return summary, the exit scenario analysis. Your 39 slides cover the operational improvement thesis. The cost structure benchmarking against the 3 closest industry competitors. The procurement consolidation opportunity worth $11.4 million annually. The real estate rationalization opportunity worth $4,200,000 annually. And the workforce optimization opportunity worth $18,700,000 annually. The $18,700,000 is the largest line item in the cost reduction thesis. It is slide 23. Slide 23 took 4 hours to build. It has 3 data points and 1 chart. The press release goes out Tuesday. You are not in the room where it is released. You are at your desk, beginning the 100-day plan. The 100-day plan is the operational execution document that translates the slide deck into action items, owners, and timelines. The 100-day plan is more specific than the slide deck. It names functions rather than headcount ranges. It assigns the workforce optimization execution to the portfolio company's incoming Chief Human Resources Officer, a person who has not yet been hired, who will be brought in specifically for this role, and whose first assignment will be to execute a reduction in force they had no part in designing. The 100-day plan refers to this person as the Crow Designate. The Crow Designate does not yet exist. The reduction in force plan exists. The sequence is deliberate. You do not know the name of any employee at the target company. You know the function distribution. Operations, sales, corporate technology, and the average fully loaded cost per employee in each function. You know that the operations function, at 412 employees with an average loaded cost of $71,300 each, is the function with the highest optimization potential relative to industry benchmarks. You know this because you built slide 23. Slide 23 does not have a list of names. It has a function, a headcount, a benchmark, and a gap. The gap is the workforce optimization opportunity. The opportunity is 412 people, none of whom know their function is on slide 23. The acquisition model does not contain names. It contains headcount ranges, function distributions, average loaded costs, and benchmark gaps. The people inside the ranges are not visible to the model. They are the variable through which the gap is closed. Closing the gap is the plan. The plan uses the phrase workforce optimization. Because the phrase describes the financial mechanism accurately, and because it does not require the model to contain names. The names arrive later. They arrive in the 100-day plan. By then, the acquisition is complete, the price is paid, and the optimization is a contractual obligation to the fund's limited partners. 2.5 years later, you are 27 years old. Your title is Vice President. Your total compensation last year was $381,000. You sit on the board of 3 portfolio companies. One of them is the company from the slide deck, the 1,247 employees, the $340 million acquisition, The workforce optimization on slide 23. 18 months into the 100-day plan, the company has 984 employees. 263 positions were eliminated. The operations function reduced from 412 to 291. The CHRO designate was hired 11 days after the acquisition closed. She delivered the reduction in force in 2 tranches, 114 positions in month 4, 149 in month 9. You were in the board meeting for both announcements. You were not in the building on either day. The operating cost reduction is tracking at 21.3% against the 23% target, 2 percentage points short, which the current quarter's management team has a plan to close through a procurement renegotiation that should produce an additional $3,400,000 annually. The EBITDA margin has expanded from 11.4% at acquisition to 16.7% at the 18-month mark. 16.7% is above the acquisition thesis projection of 15.9% for the same period. The company is performing ahead of plan. The model is working. You visited the company's primary operations facility last month. The facility employs 291 people, down from 412. The work performed by the eliminated 121 positions has been redistributed. Some of it was automated. Some of it was absorbed by the remaining 291. The remaining 291 are performing the work at a higher output per employee than the 412 were. This is called productivity improvement. The productivity improvement is real. The productivity improvement means each of the remaining 291 employees is doing, on average, 1.41 times the work they were doing 18 months ago. They are paid the same salary they were paid 18 months ago. The salary has not increased by 1.41 times. The EBITDA margin has 10.22. You spoke to 3 employees during the facility visit. The conversations were brief, professional, and conducted in the presence of the company's chief operating officer. One employee, she operates the quality assurance line, told you, unprompted, that the past year had been the hardest of her career. Not because of her own job security, because of the people who were no longer there. She said the team used to cover for each other. She said covering for each other is harder when there are fewer people to cover. She did not say this as a complaint. She said it as a fact. You wrote it down in your visit notes. The visit notes went into the board package. The board package does not have a line item for what covering for each other costs when the team is smaller. The model does not measure that. The model measures what can be measured. EBITDA margin can be measured. Productivity per employee can be measured. The cost of doing 1.41 times the work for the same salary cannot be measured in the units the model uses. The model therefore does not measure it. The board package does not contain it. The exit deck will not reference it. The company's EBITDA margin at exit will be the number that determines the return. The return will be distributed to the fund's limited partners. The limited partners will evaluate the return. The return will be satisfactory. The quality assurance operator's comment about covering for each other will not be in any of the documents reviewed during that evaluation. 4 years after the acquisition. You are 31 years old. Your title is Managing Director. Your carried interest, the share of the fund's profits above the hurdle rate that is allocated to the investment team, has begun to vest. The vesting is tied to the fund's performance across all portfolio companies, not just this one. This one is being sold. The exits process has been running for 14 weeks. You are managing it. The company being sold has 891 employees. At acquisition, it had 1,247. The reduction of 356 employees over 4 years is documented in the company's employment records, in the Crow's annual reports to the board, and implicitly in the EBITDA margin expansion from 11.4% to 19.3%. 19.3% EBITDA margin on trailing 12-month revenue of $214,700,000 produces EBITDA of approximately $41,400,000 at a 10.8 times EBITDA multiple. The midpoint of the comparable transactions range your team has established. The enterprise value is approximately $447 million. The fund paid $340 million 4 years ago. The return on the equity invested, net of the leverage the fund used to finance the acquisition, is approximately 3.7 times the invested capital. The acquisition thesis projected 3.2 times. The actual return is 3.7. The thesis was conservative. The bid process has attracted 6 potential buyers, 2 strategic acquirers, and 4 financial sponsors, meaning 4 other private equity funds. The strategic acquirers are interested in the company's market position and customer relationships. The financial sponsors are interested in the EBITDA margin, the remaining cost optimization opportunities they have identified in their own due diligence, and the company's debt capacity for a leveraged buyout. The financial sponsors' due diligence teams have each built their own slide decks. The slide decks contain workforce optimization opportunities in the operations and corporate functions. The operations function currently has 291 employees. The new buyer's slide decks describe the operations function as having optimization potential of between 15 and 20% relative to best-in-class benchmarks. 15 to 20% of 291 is between 44 and 58 employees. The optimization potential identified by the new buyers is the labor that was not eliminated in the previous optimization. The previous optimization created the benchmark gap. The new optimization will close. The winning bid comes from one of the financial sponsors at $461 million, above your team's valuation midpoint. The sponsor's investment committee approved the bid based on a 3.4 times return target over 5 years, which requires approximately a 17% EBITDA margin at exit, 2 percentage points below the current margin, providing a buffer for the operational disruption the transition will create. The transition will create disruption because acquiring a company, replacing its leadership, executing a new 100-day plan, and communicating another workforce optimization to the 891 remaining employees is disruptive regardless of how well it is managed. The sponsor's model accounts for the disruption as a revenue haircut in years 1 and 2. The model does not account for it in any other unit. The quality assurance operator has been at the company for 11 years. She is not in the new buyer's model. She was not in yours either. The company that is sold is not the company that was bought. The company that was bought had 1,247 employees, 11.4% EBITDA margin, and a management team that had run the business for an average of 7 years. The company that is sold has 891 employees, 19.3% EBITDA margin, and a management team installed 18 months into the ownership period. The buyer is acquiring the transformed version. The buyer's model will identify the remaining optimization opportunities in the transformed version. The optimization opportunities exist because the previous owner stopped short of closing all of them. Stopping short was the correct decision. Closing all of them would have damaged the business's capacity to function. The remaining gap is the next buyer's thesis. The cycle is the asset class. 7 years after the associate built slide 23. You are 43 years old. You are a general partner. The fund that acquired the company for $340 million is in its final distribution period. The fund's total committed capital was $1,400 million across 12 portfolio companies. The fund has exited 9 of the 12. The 3 remaining companies are in various stages of the value creation process. One is 18 months post-acquisition, one is preparing for exit, and one is in a performance recovery situation following an operational disruption in its primary market that the acquisition thesis did not anticipate. The recovery situation has required 2 board interventions and a management team replacement. The model for that company has been revised 3 times. The current model projects a 2.1 times return, down from the original 3.6 times thesis. 2.1 times on the invested capital is below the fund's target. It will pull the fund's blended return downward. The fund's blended net internal rate of return across all realized and unrealized positions is currently 22.7%. The hurdle rate, the minimum return below which no carried interest is earned, is 8%. The fund is well above the hurdle. the carry pool, 20% of profits above the hurdle on the total fund, is approximately $312 million across all partners. Your share of the carry, based on your partnership percentage, is $47,300,000. Of that, $31 million has been distributed in prior periods as deals were exited. $16,300,000 remains subject to the clawback provision. The contractual right of the limited partners to reclaim carry distributions if the fund's final return falls below the hurdle. The clawback has not been triggered. The remaining portfolio is not expected to trigger it. The expected outcome is that the $31 million already distributed is yours. The expected outcome has been the outcome in every fund you have managed. Your limited partners include 3 state pension funds, 2 university endowments, 1 sovereign wealth fund, and 14 family offices and institutional funds of funds. The pension funds represent the retirement savings of approximately 417,000 public employees. Teachers, transit workers, sanitation workers. Their capital is in your fund because the fund's return history supports the allocation. The return history is real. The returns were produced by 12 portfolio companies across 7 years. The companies had a combined workforce of approximately 14,800 employees at acquisition and approximately 11,200 at the point of exit or current valuation. The difference, 3,600 employees, is not a line item in the fund's return presentation. The fund's return presentation contains the IRR, the multiple on invested capital, and the benchmark comparison. The fund's returns have been consistently above the benchmark. The limited partners are satisfied. You have managed 3 funds across 18 years. The 3 funds have collectively returned approximately $2.3 billion to limited partners above the invested capital. The companies that produce those returns are still operating, most of them. Some are stronger than at acquisition. Some were weakened by the optimization process and have struggled to recover after exit. One was acquired by a strategic buyer in year 3 and has grown significantly under that ownership. The strategic acquirer invested in the business rather than optimizing it, and the business responded accordingly. You have thought about that company occasionally in the years since its exit. Not with regret, with the specific recognition of someone who made the decision the fund's mandate required and who observed, from a distance, what a different decision might have produced. The fund's mandate required the optimization. The optimization produced the return. The return justified the fund. The next fund raised $1.9 billion. The fundraise was oversubscribed. The fund's limited partners include the pension funds of 417,000 public employees. The fund's returns are distributed to those employees' retirement savings. The returns were produced by portfolio companies, whose workforces were reduced by a net 3,600 employees over the fund's life. The pension beneficiaries and the displaced employees are not the same people. They are also not entirely different people. Some of the pension beneficiaries work in industries adjacent to the portfolio companies. Some live in the same communities. Some know people who were in the workforce reductions. The capital that funds retirement security and the labor that is optimized to produce it are not separated by a wall. They are separated by the structure of an asset class. The structure is legal. The structure is the business model. The business model is why the fund was oversubscribed. The slide deck is 47 slides. An associate built slides 1 through 39 over 92 hours across 11 days. Slide 23 is the workforce optimization slide. It has 3 data points, 1 chart, and a gap of $18,700,000 between the company's current labor cost structure and the benchmark. The gap is the opportunity. The opportunity is 1,247 employees viewed through the lens of a function distribution and an average loaded cost. The slide does not contain names. The slide contains numbers. The numbers are correct. The press release went out on a Tuesday. The employees learned the acquisition was complete. They did not learn what slide 23 said. They did not learn that the 100-day plan would arrive before the Crow designate, or that the Crowba designate would be hired specifically to execute a plan she did not design, or that the plan would produce 2 tranches, 114 positions in month 4, 149 in month 9. Denominated in headcount ranges that became names when the notifications were sent, the company was sold 4 years later for $461 million. The fund paid $340 million. The return was 3.7 times the invested capital. The return was distributed to the fund's limited partners, which include the pension funds of 417,000 public employees. The distribution reached retirement accounts. The retirement accounts are real. The returns are real. The 356 employees who were not at the company when it sold are also real. They are not in the same document as the returns. A new buyer owns the company now. The new buyer's slide deck describes the operations function. Currently 291 employees, as having optimization potential of between 15 and 20% relative to best-in-class benchmarks. The new buyer's slide deck does not use the word layoffs. It uses the phrase workforce optimization. The phrase is accurate. The phrase describes the financial mechanism without naming the people inside it. The people inside it do not know they are in the phrase. The press release will go out on a Tuesday. The model is not wrong. The model prices the opportunity correctly. The model produces the return the fund's limited partners require. The return funds retirement savings for people who spent their careers in industries the model has never modeled. The cycle is visible from here. It was visible from slide 23. If you knew what the numbers were for. The numbers are for the return. The return is for the fund. The fund is for the limited partners. The limited partners are for the retirement. The retirement is the reason the fund was oversubscribed. The slide deck does not use the word layoffs. It uses the phrase workforce optimization. The phrase has been in the vocabulary of institutional finance for long enough that it no longer requires explanation inside the rooms where it is used. It is a technical term. It describes a technical process. The technical process produces a number. The number is on slide 23. Slide 23 does not contain names. The names arrive later. By then, the acquisition is complete. The price is paid, and the optimization is an obligation. The obligation is the gap. The gap was always the business model.